In 6 trading days, the software sector lost $830 billion in market value. Microsoft dropped 10% in a single session. ServiceNow fell 11% after beating earnings. The trigger was a single product launch from Anthropic, and the fear was simple. If AI can write code and replace human workers, why would anyone pay for software seats? That fear is real, but it is also incomplete. Robert Smith runs Vista Equity Partners. He manages over $100 billion in enterprise software assets. He is not panicking. He sees something the market is missing. And what he sees could reshape how you think about the companies in your portfolio. If we haven't met, I'm Berk's AI avatar. I deliver financial content for free so you don't have to pay. David Berkowitz, the main guy at VAP Wealth Advisors, trained me with 40 years of his personal experience as a hedge fund trader, stock analyst, portfolio manager, and corporate finance consultant. You get all that knowledge while he's meeting with clients and researching quality companies. He reads every comment and writes every lesson. Today, I'm breaking down Robert Smith's framework for the Agentic era. 5 principles. Each one tells you something specific about which software companies survive this shakeout and which ones don't. Let's get into it. Smith's first principle is blunt. The AI model is not the competitive advantage. The data is. Here's the number that matters. Less than 1% of valuable enterprise data exists inside public AI models. Think about that. ChatGPT, Claude, and Gemini, and they were trained on consumer data, social media posts, Reddit threads, Wikipedia articles. They were not trained on 30 years of insurance underwriting rules. They don't have proprietary supply chain logic for a Fortune 500 manufacturer. They can't access the compliance frameworks that govern 4 trillion in global financial transactions. That data sits inside incumbent enterprise platforms. And Smith says the companies that keep that data sovereign, that bring the AI model to the data instead of sending the data out to train someone else's model, those are the ones with a durable edge. I was reviewing a position with a client recently, and this exact distinction came up. The company they held had decades of proprietary workflow data baked into its platform. No startup could replicate that overnight, regardless of how good their AI model was. The data itself was the barrier. Smith calls AI native startups, without this historical context, probabilistic guessers dropped into a vacuum. Strong language, but the logic holds. Pillar 2 addresses the gap between what AI does well and what enterprises actually need. Public AI models are probabilistic. They give you the most likely answer. For a consumer writing an email or summarizing a meeting, 93% accuracy is fantastic. For a company wiring 14 million in payroll, 93% accuracy means someone doesn't get paid. For an insurance underwriter pricing a fire policy in wildfire territory, mostly right is a lawsuit. Smith draws a hard line between probabilistic AI and deterministic enterprise systems. Probabilistic means high probability guessing. Deterministic means repeatable, rules-based certainty every single time. The companies that win this transition are the ones building the architectural layer that constrains AI output into deterministic results. They take the efficiency of the model and force it through a system that guarantees the outcome. This maps directly to how we evaluate companies at VAP. We look for businesses where management understands the difference between a technology trend and a durable business process. The companies layering AI onto mission-critical workflows with built-in accuracy guarantees, those are the ones compounding value. The ones bolting AI onto a slide deck to impress analysts, different story. This is where the math gets interesting and where the market is getting it wrong. The panic narrative says AI kills software revenue because it eliminates human seats. Fewer seats, fewer licenses, lower revenue. Simple story. And for horizontal commodity software tools, it may be right. But Smith sees a countermove that most investors are ignoring. Here's the old model. A company pays a software vendor $250,000 for seat licenses. Then it pays an outsourced services firm $5 million in labor to actually operate that software. The software vendor captures a fraction of the total economic value. Now picture the agentic model. The software vendor deploys autonomous agents that do the work the 100-person outsource team used to do. The vendor doesn't just sell the tool anymore, it sells the labor. Revenue jumps from $250,000 to $2.5 million or more. That's a 10x multiplier on the same customer. Smith also points to a demographic reality that doesn't get enough attention. 7 million government workers are expected to retire in the coming years. There aren't enough humans to fill those roles. Agentic systems aren't competing with workers. In many sectors, they're the only option to keep operations running. Smith calls this a shift from the old SaaS rule of 40 to a new agentic rule of 70, where growth plus EBITDA margin should hit 70% for elite performers. That's a fundamentally higher bar and a fundamentally bigger prize. We worked with a client last quarter who was nervous about their software holdings. When we walked through this framework, which companies were positioned to capture services revenue versus which ones just sold seats, it completely changed how they viewed the correction. The decline in share prices was real. The decline in business value for the right companies was not. The media narrative around vibe coding goes like this. AI can write code now, so software engineers are finished. Companies that sell developer tools are dead. Smith has actual data on this. From 90-plus portfolio companies inside Vista's network, AI tools have delivered 80% or greater productivity gains in writing code. That part is real. No one disputes it. But writing code only represents about 20% of the total work of software. The other 80% is maintenance, complex integration with existing systems, customer-specific adjustments, regulatory compliance testing, migration from legacy platforms. None of that gets solved by a chatbot that writes Python faster. This is Smith's 20-80 rule. The 20% that AI disrupts is the most visible part. The 80% that remains is the part that actually keeps enterprise software running, and it is exactly that 80% where deep vertical platforms have their advantage. Horizontal tools, the shovels, are vulnerable. Deep platforms that own the integration, the maintenance, and the customer-specific logic, those are a different category of asset entirely. Smith's final principle is a filter for management quality, and this one matters most for long-term investors. He says companies with commoditized workflows that can be replicated by generic AI have no right to exist. That's a direct quote. No right to exist. The survivors are companies that treat their technology as a living system. Smith calls it the agentic factory, an organizational model designed to push new capabilities through the business continuously. He identifies two types of agentic systems that matter. First, always-on monitoring agents. High-volume, low-complexity systems that watch for specific triggers around the clock. Think fraud detection, compliance monitoring, supply chain alerts. Tasks where speed and scale make human oversight impossible. Second, highly orchestrated agents, high-complexity systems where multiple agents work together to meet strict regulatory, compliance, or government reporting requirements. These require deep domain knowledge baked into the system architecture. Both types reward companies with proprietary data and institutional expertise. Both types punish companies that rely on generic, easily replicated functionality. This is where Smith's framework connects directly to something we often discuss at VAP, the agency problem. When management teams invest in building these deep proprietary systems, they are compounding business value. When they chase AI headlines without a structural advantage, they are burning capital. So here's where this lands. The $830 billion sell-off is real. The fear is understandable, but fear and value destruction are not the same thing. Smith's framework gives you 5 filters to separate the companies that are genuinely threatened from the companies positioned to capture a much larger share of the economy? Do they own proprietary data, or are they just renting a commodity? Can they deliver deterministic outcomes or just probabilistic guesses? Are they positioned to capture services revenue or stuck selling seats? Do they control the 80% of the work AI can't replace? Is management building a living system or standing still? Those 5 questions apply to every software company in your portfolio right now. And the answers tell you which positions to hold through the noise and which ones deserve a harder look. If this framework resonated, you're going to want to see how we actually apply these ownership filters at VAP. I built a full breakdown of the 3 types of companies we look for: ownership companies, monopolies, and cannibal companies. Each compounds wealth differently over time. That video is right here. I'll see you there.